A great investment opportunity occurs when a wonderful business encounters a one-time, huge but solvable problem. That's a quote directly from the man himself, Warren Buffett. So let's dive into exactly what that means, what kind of events you're looking for that put businesses on sale and make them undervalued. And also let's look into some examples of companies where that's actually happened in the last few years. So if you enjoyed today's video, be sure to hit like and subscribe so that you can watch future videos as well. But for now, let's get into it. So this is one of the many genius quotes that we get out of Warren Buffett, and it's a really practical kind of message for when you're going out and investing in great companies. So what we look for in great companies is something that has a moat, so a big sort of competitive advantage in the marketplace. Maybe they're the low-cost producer of a commodity, maybe they have a great brand like Coca-Cola, maybe they have some sort of switching moat where it's difficult to change sort of providers of a product or service that you're using. Something that gives them a big advantage in the marketplace. Those are really the kind of businesses that they're looking for because they have great cash flows over time, they have sustainable business models, they're easy to value, and you can put a big chunk of your portfolio into it, you know, feeling fairly comfortable that that business is going to be around in 5 or 10 or 20 or 30 years time. So that's the kind of business we're looking for. As value investors, ideally we want to buy them much cheaper than they're actually worth. And unfortunately, with great businesses, we don't get those opportunities all that often. Really predictable, strong businesses are often priced at their value or in and around their value all the time. They're often even quite expensive. So as value investors, how do we actually go about buying those businesses with a margin of safety? Well, we look for events. That's basically the answer to that question. So these are big one-time events that put the stock massively on sale, drop the price down huge, and value investors can pick up a huge amount of shares of those businesses really cheaply. So first we have to understand what an event is and why events actually put a business on sale. So an event is some sort of one-time solvable problem. So it's something that is going to affect the profitability of the company maybe in the next 12 months or the next 2 years, but it's really not going to affect what the business is doing in 5 or 10 or 20 years time. As long-term investors, we value a business based on the long-term cash flows of that business. And that is actually quite counter to how a lot of fund managers and shorter-term investors manage their investments. So if you're a professional investor, unfortunately, you've got a couple of big disadvantages. And one of those is that you're getting judged on a quarterly basis. And that can really, really impact the investment decisions that you make. And it can pull back your results a lot over time. So if you're investing and your performance is going to be judged on how you perform the next quarter, there's no way that you're going to hold on to the stock of a business that's going to perform well below what it's done in the past in the next quarter. So when these events happen, and a lot of the money that's been invested in the market is from these sort of fund managers, institutional, quarterly based, short-term investors. So when these events happen, all those short-term investors want to get out as quickly as possible, causes the stock price to tank, and that offers opportunity for us. So that's what an event is, and that's kind of why it forces those shares to go on sale. So I'm going to dive into some practical examples of when that's actually happened and some companies that you may or may not be familiar with that you could have picked up in the last few years. So let's get into it. So if you've watched some of my previous videos, particularly around valuing businesses, you know that I want to buy with a big margin of safety. And by big margin of safety, I typically mean somewhere between 30 and 50% of the underlying actual value of that business. So if a business is worth $100 a share, or I value it at $100 a share, I want to be buying it in the sort of $50 to $70 a share range, ideally. And the more that it goes down, the more I continue to buy, and the more shares I pick up, and the bigger margin of safety I give myself. So I'm going to look at some practical examples of when share prices have actually dipped that much and even more. And the first one we're going to look at is Chipotle Mexican Grill. So if you're a Phil Town follower, you'll definitely be familiar with this business. If you live in the States, you're probably going to be familiar with this business as well. So Chipotle is a company that makes burritos. Essentially, it's a fast casual restaurant that makes burritos and lots of kind of Mexican food. And essentially they had a big event go on 2 or 3 years ago now. So they had a problem with E. coli. They got E. coli into their food, and a lot of customers were getting very sick, and they had that event follow up with a norovirus kind of event as well. And what happened to the stock is at the time it was probably worth somewhere around $550, maybe $600 a share. It was trading at about $750, so it was significantly sort of overvalued by a lot of people's standards, but it dropped all the way down to $250 a share. So if it's valued at $250 and you value it, if it's priced at $250 and you value it at, $550, $600 a share, you've got a massive margin of safety, more than 50%. And if you look at Chipotle's stock price as of filming this video in June 2019, Chipotle is now priced in the market at, I believe, well over $700 a share again. So almost a 3x on your money if you'd picked up shares in Chipotle during that event. So the second company is a company called Gildan. So you may actually not be familiar with Gildan potentially. Essentially, they're a large manufacturer of clothes. They're the biggest manufacturer of t-shirts in the world. They provide a lot of t-shirts to Walmart and big kind of retail outlets like that. And they also have one significant competitive advantage over the rest of the clothing producers in the world. So when you're producing a lot of clothes, essentially it's a commodity, assuming you're not going for that high-end kind of branded clothing area. If you're producing low-cost basic clothing, you're basically producing a commodity, and the only real competitive advantage you can have with a commodity-based business is to be the low-cost producer. And Gildan is definitely the lowest-cost producer. If prices and margins get squeezed really, really hard, Gildan is going to be profitable longer than any of the competitors in that same sort of marketplace. So the event that happened with Gildan is a cotton crisis. So worldwide cotton growers, I think this was actually in Egypt, to be honest with you, cotton growers had a massive crisis. Cotton yields went extremely low, and cotton prices went through the roof for these t-shirt manufacturers like Gildan. So the Gildan CEO basically came out and said, cotton prices are through the roof. We're just flat out not going to be profitable for the next couple of quarters or the next year. But we've seen this before. Cotton farmers in the States and in Georgia will plant cotton. Cotton prices will normalize and we'll be back to normal again in a year or two. So what happened with all the fund managers is they got out. They didn't want to be in these poor couple of quarters, and the stock price went down from $18 a share down to $9 a share, a 50% drop. The following year it was back up to 18, and now it's back up around sort of that $30 or so range. So been a very well performing stock and another event that you could have picked up in the market. Company number 3 that had an event recently. This was actually just in the last 12 months, and that is Facebook. So Facebook, as you may or may not be aware, had the Cambridge Analytica scandal. Essentially, data was used definitely how it should not be used by Facebook, and they got in a lot of trouble. Mark Zuckerberg, CEO of Facebook and founder of Facebook, had to go in front of Congress. I'm sure you guys have all seen the headlines around this one. And essentially, Facebook stock dropped from a high of around $210 a share down to about $120 a share. So it gave you a big margin of safety if you believe fair value to be around that $200 a share mark. Didn't quite get to the 50% drop or anything, but it's probably not something that people are going to remember about Facebook in 5 or 10 years' time, assuming Facebook's still around. So it's one of those short-term events that's probably not going to impact the earning power of Facebook long-term. But in the next couple of years, they are spending a lot of money on security and that type of thing. So their profits are going to come down a little bit lower than they might have been otherwise. And that's for short-term investors to get out. And actually recently, Facebook has come back up a lot. I think they're right around $200 a share again now. So very quick turnaround on that particular stock. That's pretty common in something that's very closely followed like Facebook, where there's a lot of analysts. It doesn't often get massively mispriced unless we get a big event like this. So that's the last one. That's the third one. Now let's get into the last one, and that is actually Berkshire Hathaway. So even the greatest investor in the world's company, Warren Buffett, can go on sale from time to time. And this actually happened right around 2000 is the time that we're going to talk about this. So if you're unaware, in the late 90s, early 2000s, there was a massive bubble in technology stocks. Technology stocks were going through the roof. There was IPOs all over the place. Companies that weren't even profitable were getting billions and multi-billion dollar valuations put on them. And people in these tech stocks are making 40, 50, 60, 100% a year returns from investing in these technology stocks. And people were saying to Warren Buffett, you're missing the boat on this. You've lost your touch. You should be in technology. People are getting huge returns and you're not. And Buffett basically stuck to his guns and said, this is ridiculous. I don't understand technology, first off. Even if I did, these valuations are just obscene. It's never going to work out long term. But people didn't really listen in the market. And Berkshire Hathaway's stock price went down from around $80,000 per A share down to about $45,000 per A share. So to have the very best investors in the world, company that produces massive amounts of cash flow drop nearly 50% is insane. And Berkshire Hathaway now is trading around $300,000 a share as I'm filming this. So it's almost a 10x on your money over the last sort of 18, 19 years since that low price of $45,000 a share for that company. So even the greatest investors in the world can have their business go on sale. So in terms of practical takeaways, hopefully that gives you some good examples of the types of events you're looking for. You're looking for something short term, something that's not going to affect the earning power of the business over the next 10 or 20 years, but it certainly will in the next maybe 6 months or a year or 2 years. Those are the types of events you're looking for. It's going to put the company on sale short term, but you're going to be fine long term. So that's all from me today. I hope you enjoyed the video. If you did, please drop it a like and hit subscribe. And you can also hit subscribe. I think it's over here. I know I got it the wrong way around in the last video, but I'm pretty sure it's over here. If not, it's probably over here somewhere, and you can watch other videos whichever way I've put it. So hope you have a great day, and that's all from me for now. Cheers.